Good morning, everybody, and thank you very much for taking the time to dial in. I recognise if everyone's found that as easy as possible. I can see that there are people continuing to try and dial in. As many of you know, we tend to get together fairly regularly at Pacific to discuss markets. The last time we decided to open this up to our clients was in December 2018. In December 2018, the S&P fell 15% in 3 weeks. We've managed to fall about 12% in 5 days over the last week. And so we thought it'd be a good opportunity to really kind of give people a little bit of insight in terms of what we're thinking and how we're looking at the market. It's a fairly fast-moving beast, as we can see. Over the weekend, there was stimulus announced in places like Italy and China, and what we've seen as confidence in the central banks and their ability to act increases, we've seen markets bounce off the lows this morning, but still potentially far wider reaching implications to GDP around the world. So I thought what we'd do is we'd start with Will Bartleet, our CIO, to give us a bit of a recap on kind of what's happened over the last week. I'm joined also by Richard Marshall, Shane Dunlap, and Oleg on the G10 macro team. These guys specialize in trading interest rates for institutions around the world, so hearing some of their thoughts. I'm really pleased that Camille Dimich has also joined us. Camille runs an emerging market, long-only emerging market equity fund, and has been part of the team and runs around about $500 million for institutions around the world in emerging market equities. So they've got a fairly interesting perspective as well. So between interest rates, emerging markets, and multi-asset, hopefully there's enough to discuss. We'll try and go on for about 20-25 minutes. We won't go for too long. Feel free to drop off if there is no necessity to stay, and feel free to ask any questions. So Will, why don't we kick off with some of your kind of initial thoughts?
Well, I think the context of this fall is very important. I mean, the backdrop was that there was quite significant risk-taking at the start of the month. We saw, first of all, from a valuation perspective, a long-term metric. U.S. equity markets valuations were as high as they've been for many years, and only a couple of points have they been higher on a margin-adjusted basis. Elsewhere in the world, valuations are much lower, but certainly there are pockets of very high valuations. And then risk-taking was pretty extended. We saw, particularly the fast money, the hedge funds, equity funds, had taken on more risk in November, December, and January, and were as extended as they've been at any time apart from ahead of the fall that Matt mentioned at the beginning. And then finally, we saw retail investors start to join the party. Retail investors often late, and the signs of speculation, and particularly in the most extreme loss-making companies like Tesla and Virgin Galactic, where we saw lots of retail investors finally getting involved, which often marks the top, at least a short-term top in markets. So signs of certainly complacency in some areas of risk-taking, and that really meant that the market was very poorly equipped to cope with a shock of this order, and that's why we saw such a sharp fall. I think in markets, it took 6 days for the S&P to fall from its peak. That's the fastest fall ever, going back to the Second World War. So really, although the peak to trough so far of 13% is by no means unprecedented, it's quite a normal reaction. Really, the speed of it has been pretty unusual. The other thing that's worth mentioning is really in terms of liquidity, this market has been really quite orderly. We saw the first response was from the bond market, from the rates market. I'll let the macro team talk about that maybe in a few moments. But really, the bond market saw the problem before the equity market. Then we've seen this very sharp fall in equities. And really, less liquid markets have only just started to respond. Credit markets sold off in the second half of last week, from a point where at the start of this process, credit spreads were very tight. And we think, in terms of looking forward, credit spreads are an important indicator to watch for a few reasons. First of all, if we're expecting lasting damage, then we think credit spreads will widen quite significantly. We know there's some leverage, build-up of leverage in some parts of the market. Secondly, very importantly, the Fed will be watching it very closely. because signs of credit spreads also indicates what's happening in lending markets, and so they will be responding to that. It's one of the reasons maybe why the Fed responded over the weekend. And finally, for us, we'll be thinking about opportunities. But before we come on to that, maybe I'll pass over to talk about the rest of the world.
Yeah. So before we get on to, I think the credit spreads is an interesting thing, because I think that there are a lot of companies out there that have benefited from continually rising equity prices, which has meant that they could borrow and keep their debt to equity ratios low, or they can continually offer more equity out to try and raise capital. But before we get on to that and the implications of lower rates, on that, I think that, Camille, in terms of emerging markets, the coronavirus was, there was quite a lot of noise about this 6 weeks ago, and the emerging markets sort of seemed to contain it. They didn't, how have they sort of behaved? Are they having another leg down? And is there an opportunity now to start looking to invest in emerging markets or topping up in emerging markets? What are you guys doing?
Yeah, sure. So we've been in the sort of eye of the storm, if you like, with the outbreak starting in China, which is a major part of our markets nowadays, much larger than it was, say, 10 years ago. And it sort of gives us a bit of an insight into how things might develop in the rest of the world. And I tend to think of this as a two-phase process. The first phase was where the coronavirus was exploding in China, and sort of the number of cases there was increasing exponentially, while the rest of the world seems to be rather unscathed. And really, I think that led to this, Will alluded to this recent sort of risk-taking activity, which was happening well after the coronavirus was a known issue. But people simply assumed that it was something that would be contained in China and wouldn't spread. And I think this leg down we had last week was probably as people increasingly realized that in fact it wouldn't be contained to China. Now the funny thing is, well, not funny, but the paradox is that in China it looks like infections have peaked, and you may question those numbers. They've been questioned before, but what is unquestionable is that the Chinese economy is gradually resuming activity. So you're seeing traffic levels start picking up. They're still quite a lot lower than they should be this time of year. You're seeing coal consumption starting to pick up. And really, when you talk to companies, most big companies that we talk to are well on track to resume production. They've all been obliged to put in place various measures that separate people, whether it's in canteens or at the manufacturing line. And so there's been a lot of investment in processes that will help slow the spread of the virus, but ultimately China is learning to live with it. And so in a way, for us, we see the opportunity, and we have been adding to China in the past few weeks. We see the opportunity as China is now facing a point where the drama of the virus has sort of peaked, and what you're going to see now is help from the authorities in terms of stimulus. Now that could be partly in terms of additional lending and additional cash injections into the system, and partly good old-fashioned building stuff. So you're talking about usage of cement and steel, and actually cement stocks are doing very well in China. So this is potentially your playbook for the rest of the world, but the rest of the world is still staring down the abyss where cases are going to continue rising dramatically, and so we're in a different phase here. So that's kind of how I see the.
Now, how do you see so just on the fiscal stimulus, let's stick with emerging markets for a bit before we go and talk to the macro guys in terms of fiscal stimulus, or monetary stimulus or fiscal stimulus. How quickly can the Chinese or emerging markets in general get that stimulus? The kind of the transfer of that stimulus to start to reflect into kind of the growth numbers. And then the other thing is, what are the expectations of the reduction in growth? So maybe you can get quite a big recovery back in, almost like the inventory restocking story we saw in 2009. But are you expecting to see worse numbers out of China when we finally get that kind of the quarter-on-quarter growth numbers and things like that? Do you think it's worse than the economists are suggesting, or do you think market speculations about right?
Yeah, look, I think nobody really knows. So the initial numbers we've seen out of China in terms of PMI, which is more of a sentiment indicator, have been weaker than what people had been penciling in. But I think ultimately that's meaningless. I think far more important was, what you asked, your first question was, which is how quickly things can get back on track. And I think that's partly a question of stimulus, but also partly a question of getting people back to work and getting things back to normal. So throwing money at China and at the economy when no one's actually working or spending money isn't going to make much difference. I mean, Hong Kong just did a real life example of helicopter money where they just handed out $1,000 US, actually more than that, $1,300 US to every resident. It's unlikely to kickstart the economy until people are actually going out and spending. So the question is, how quickly do things resume? In terms of the loss of output, there's an interesting little bit of data that was out over the weekend or at the end of last week, which was China housing sales, so the big developers' property sales. And these were down on average about 25% in January and February versus your typical January and February. And remember, this is very much low season because it's Chinese New Year anyway. So typically January and February account for about 10% of annual sales. So assuming these sales have been lost and will not get caught up later on, people have just deferred their purchasing decision, a 25% decline of 10%, so that's you've lost 2.5% here of.
So actually what you're saying is that in some ways, given that January and February is not hugely productive for emerging markets, China anyway, then actually this was probably not a bad time for it to happen for you.
Yeah, it's probably the best time for it to happen. But the question really is, and I don't have the answer, although I can say that certainly all evidence shows that things are moving in the right direction, is how quickly things resume back to normal. Because if you can get back to normal by April, May, ultimately the impact of this is not going to be huge. And I would hate to quantify it because I don't think anyone really knows the precise number, but it's not going to be very meaningful. And the way we think about equities is as a very long duration instrument. We're looking at cash flows over the next 10, 20, 30 years, and we're trying to put a value on that. I don't think those cash flows are dramatically affected by the loss of a quarter's worth of GDP. If it's a one-off situation, it would be different if you're telling me that a large portion of humanity gets wiped out by the virus, because then clearly there is less future potential. But I don't think anyone is suggesting that this is likely to be the case.
So talk to Shane, Rich, and Oleg on the effect on kind of interest rates as well. What we've seen is a lot of people worried that this is potentially could be a supply shock, which ultimately could cause things like inflation and those sort of things. But there is the possibility that this becomes a bit of a demand issue, because suddenly the consumer, i.e. the US, suddenly sees their number of cases go up. It's socially unacceptable, however potent the virus is or isn't, to not do anything about it. And as a result, people stop the movement of people and all those sort of things, and schools close, and people worry about the Olympics of Japan and those sort of things. And that has to affect the demand side rather than just the supply side, which I think is one of the major concerns with EM. So I know you've been speaking to some industry kind of experts, particularly around the virus. What's your kind of view, firstly, on how the virus manifests itself from here in terms of cases, and also how do central banks react and the implications of that on the interest rate markets, the credit markets, and those sort of things?
Thanks, Matt. Well, just to point out that we're not experts on anything medical here, but the market is obviously going through a period of fear, and that mainly from our side is a lack of information. So the more information that comes out about mortality rates and how many people out there are truly infected, I think the less the market will begin to factor in a radical kind of outcome. So I think the bond market itself, I think, has been more realistic, I think, than the equity market for some time. It started off last summer with the trade wars, where we had a big dive into duration and grabs for yield. That came off a little bit later on in the year, as the trade war resolved itself, but the actual flattening of the curve really didn't reverse that much. And what we're seeing here with this new fear factor is actually the initial response from rates was again the same thing, rallying, flattening curves, and in this case actually striking out to new lows of yield. The US 10-year benchmark is something that's followed by many people, and that's now reaching a low of just I think this morning 109%, so 1.09.
1.09.
Yeah.
So you lend your money to the US government, you get 1%, basically for the next 10 years.
10 years, correct. But mind you, that's better than obviously Germany.
Germany
will agree, Stephen. Germany is negative 63 basis points. So but it's a flight to safety. It's people just wanting to guarantee that they're going to have their money back. And again, it's that fear of the unknown. So I think
before coronavirus, then people were already worried that these kind of almost zero rates or negative rates were not being as effective. And actually, some of this gap between rich and poor is explained by the fact that quantitative easing has seen asset prices go up, but not but no real wage inflation. Is this? And there was talk at the beginning of the year, of a fiscal stimulus. I think Mario Draghi actually even said when he was leaving, the ECB, look, come on countries, you've got to get involved with some fiscal stimulus, which no one really liked him saying, but there's only so much monetary stimulus or negative rates the world can do. Is this the excuse, this along with ESG and a number of other environmental things, to get people to do much more fiscal stimulus? And how do the bond markets react to that?
Well, I think that's absolutely correct. I think Lagarde, when she came in, also followed on with that mantra, and I think why it's been taken a lot more seriously now is that two factors. One, the market's pricing in quite radical cuts over the next 12 months in the US.
So what's the market pricing in terms of interest rate cuts?
About just over 1%, about 100 basis points of cuts in the US in the next 12 months.
So that's over the next 4 meetings. That could be 25, 25, 25,
and
20.
And it's quite possible they actually do a 50 in the first meeting. That's not off the cards.
Yeah.
At this point in time.
Do you think 100 priced in over the next 12 months, 100 basis points or 1% of interest rate cuts is too aggressive, or do you think that's a...
It depends really on your outlook. Typically events like this are quite V-shaped in nature in terms of their impact on the economy. And so my personal view is that actually 100 basis points is quite excessive if that 100 basis points persists, for 12 months, 18 months or something like that. I think once we get through the peak, fear, the peak worry, and we, as Camille says, we learn to live with the virus, which is what we're going to end up doing, we will find that actually things really aren't as bad as everybody worries about, and that actually economic activity will come back, it will pick up, and those cuts further out in time may not be as appropriate as everyone thinks right now.
So what sort of fiscal stimulus could banks do? I mean, that's a question, I guess, for you guys, for Will. I mean, the banks have already lent a heck of a lot over the last 10 years. Is this kind of, bridges to nowhere, infrastructure projects? Is it putting money, the Hong Kong citizens, let's put £1,000 in? Is it tax cuts? What do you think, how does this manifest itself?
Probably all of those, to be honest. These kind of issues are quite country specific, and each country needs a different package, and actually it's exactly what governments are set up to do.
What's also interesting is, like, for Japan, although we do focus on Japan, it is very important, as we have seen in the previous cycle of slowdown, global slowdown in 2015-16, it is very important what China does. And US on itself, like, we know that with the tax cuts, Trump essentially did the fiscal stimulus in the US, but it didn't really kind of affected the rest of the world that much, because the US is still a delayed economy, and China, for example, I would argue potentially is more important for Europe than US is, and it's clearly more important for Japan and what Australia does, and that's kind of a big part of Japan markets at the moment. So
yes, yeah. And well, what do you so let's put things into perspective. I mean, you mentioned 2015. There was another talk. I think you mentioned that the speed of the drawdown was quicker than 2008. I think in 2008, when you started to see some of these drawdowns, it took equity market valuations back quite a long way, to kind of 2 years prior. These drawdowns have really taken equity market valuations back to kind of October, November. Is it really there's a lot of people. I mean, I remember I've got various people were ringing me up on Friday saying, I think maybe we should add now, and everyone was getting excited about that. I don't think, as to Camille's point, we're quite at the point of learning to live with it. The UK's cases, were up 100% over the weekend, and I was on the train this morning. There wasn't one person wearing a mask, so I don't think we're quite at the panic stations here. But where do you think? When would you start to think about adding risk, or what risk should we add, or is this still there's too much news flow to come?
Well, I think in the short term we can be certain of a lot of volatility in both directions, because the market's fallen extremely oversold, and so whatever happens, we're going to get a bounce and a lot of volatility. VIX is, the measure of volatility is extremely elevated, so you should expect to feel the sense of extreme fear, extreme greed in probably quite short order. I think in the next few weeks. The important thing is, first of all, when does the market discount it? We've gone from euphoria, certain signs of extreme risk-taking in certain areas of the market, to, I'd say, fear, but we're not at extreme fear yet. Kind of surprisingly in some ways, although it's a very sharp fall, but some of our indicators that typically get very oversold after these sort of falls are actually not quite there yet. That's a little bit of that just tells you need more time. So I would expect a lot of volatility around for the next few weeks. In terms of valuations, there's a huge divergence of valuations across markets between the most expensive markets, the highest valued stocks in some parts of the US, and cheap markets, say in EM and other parts of the world. So of course, to begin with, everything has fallen. There's been very little that's held up. Even, for example, a low volatility S&P tracker fund, it fell by more than the S&P in the last 3 days. Everything has been written.
And gold fell on Friday as well.
Gold fell on Friday, which tells you that there's some margin calls, people selling stuff because they have to sell it rather than they want to sell it. So you should expect, so you should expect some volatility, I think, in all assets. But then once we get to see, first of all, it's discounted by everybody, both the market and by individuals, because to begin with, a lot of people are saying this is not a real thing, it's contained, as Camille was saying at the beginning. Once it's become accepted, then I think we can start to see the chance to add some risk. And that will be both from our perspective, both in equities, where we've been quite defensively positioned, but also in other risk assets like credit that I mentioned at the beginning, where credit spreads could we think widen quite a lot from here and provide some really interesting opportunities, as they did in 2016, and of course most notably of all in 2009, when there were an incredible thing to buy when markets were oversold.
So let's explore credit spreads a little bit. So clearly the blowout of credit spreads, the emerging market debt's reliance, I guess, on paying back in dollars and the dollar strengthening, and you've got a much lower rate, potentially a lower rate environment, particularly if you're factoring in 100 basis points worth of cuts over the next 12 months. How do we? Doesn't this make it easier for people to borrow? If you can, and therefore the reach for yield becomes even more exacerbated. One of the things that I was reading over the weekend was this idea that if the supply side does get cut off, as a function of supply constraints, and then what you end up doing, which is like was in the oil crisis in the 1970s, and then what ended up happening is that everyone pumped a whole load of fiscal stimulus to offset the problem with high oil costs. But there was a supply problem, and then that just caused stagflation. You had a whole load of inflation with no real growth. Is this a mistake that could happen this time? If there is problems with moving goods, because the world's more globalized than ever before, that actually you end up getting some inflation, but you're also piling on fiscal stimulus, so you get no growth with inflation. Are those things? Could those things happen? And that's the only way you could sort of start to see credit spreads widen in a lower rate environment.
Well, I think that's possible, but probably a little bit further out. I think for now, you can see the very long end of the bond yield curve falling. that's a sign of fear of deflation, because growth is being constrained. Further out, that is possible if this cycle continues. Now we're looking maybe a year out. If this cycle continues, it just turns out to be just a bump in the road, a hard bump in the road, but still a bump in the road. Well, then that's possible. I think that's probably a bit ahead of ourselves. Really, credit spreads is all around what happens if lending stops. What happened? Partly it's where back to the beginning, where you weren't being rewarded, very highly rewarded for taking risk at the beginning, and by the end of this episode, you could well be very well rewarded, and that will be an opportunity to buy.
And are you seeing many of the? I mean, are we seeing any sort of signs collectively around, maybe an EM around what's happening in the debt markets around the lending? I mean, I guess in China they can just tell the banks to lend.
Yeah. So I mean, credit is an interesting one, because if my base case, and I think most people's base case, is this is a one-off shock to the system and not a permanent destruction of demand, and so eventually when we learn to live with things, demand does recover. So the challenge with credit spreads, of course, and in particular the high yield spaces, a lot of these companies need to make their debt payments, and so a one-off shock can tip you into default quite easily, because if you have no revenues for 1 or 2 quarters, you're just not going to be able to repay your debts. And if banks are unwilling to refinance, or if you've got bonds outstanding, that can cause a problem. So you want to be positioned in a way that you kind of have the survivors. You want to have the guys with strong balance sheets. And a lot of companies, both in the US and in EM, do have these strong balance sheets where they can quite easily afford to not have any revenue and make losses for a couple of quarters. So I think, especially in the high yield space, my view is, and when we look at equities that are highly leveraged, I think there is a danger of some of these having issues. Now, in terms of the policy response, clearly, I think policymakers are aware of this, and in places like China, where banks are largely state-directed, they can certainly direct banks to roll over and restructure debts for borrowers like this, with a view, which probably isn't inaccurate, that these borrowers will eventually recover and will be able to service those debts once things normalize. I think in other countries, in EM, banks are far more independent and will have other constraints. So I would treat China as a little bit of a special case. So other EM countries I would treat more like developed markets, where banks can choose to lend or not lend, and really investors will make that decision, will make that call.
Is there any view from anyone around the table in terms of the impact that this may have on the trade war negotiations and discussions?
Well, I certainly think in terms of the political impact, I think it's very important. I think that's one thing we certainly should mention. There's an election coming up at the end of the year in the US. Trump he's put his full guy in place. He's put the vice president in place to manage the crisis. But whether the public will forgive him, either there is a crisis, I think is really very important, because clearly if we get a Democrat into the White House, well, the stock market's not going to like that. Because of their policies, reversing the inequalities that you mentioned earlier on, that will not be very good for the US corporate. So I think this is a very important political impact if it seems to be managed badly by Trump.
So a question then, if you're building a portfolio, and probably for the macro guys more than anyone else, is that you have your risk asset, which is your equities, and you have your safe haven asset, which is your bonds. Your sovereigns, your treasuries, your gilts. I mean, they've sort of worked in the last, few weeks, and like you said, maybe since August, where you've seen a nice rally in bonds. If this ends up being more of a V-shape, a bump in the road, albeit a hard one, what does that mean for your kind of interest rate assets, your bond assets? Because what seems to happen at the moment is that there seems to be this ratchet system with bonds. There's a crisis, they rally. Everyone gets over the crisis, they don't sell off much. There's another crisis, they rally again. And this goes on. It seems to go on forever. And does that mean just perpetual negative rates, Japanification of markets, interest rates at zero forever, or do you think? And how important is what the Fed is doing versus what Europe's doing? Because they're different parts of their economic cycle. Europe is much closer to recessionary, particularly Italy and places like that, which might justify its negative rates. But you're now getting much closer compression between the US and Europe. So
yeah, you're right.
A minute or two on that sort of.
Yeah, my view is that the countries that have the relatively high yields, and they're not relatively high anymore, to be honest, but the likes of Australia or US, Canada, New Zealand, Norway, Sweden, they've got the ability to cut, and I think in this particular circumstance they will, and I think the added rhetoric about this fiscal targeting. We didn't see that last summer to the same extent at all, and I think the bond market's beginning to believe that this may actually eventuate, because for the first in the last few sessions we've actually seen the curves just beginning to steepen, and we haven't seen that for a long time in any meaningful way. So it might be.
So explain to the layman, i.e. me, how does fiscal stimulus differ, the impact on the kind of bonds differ from monetary stimulus? And obviously monetary stimulus, you're cutting rates. When you have fiscal stimulus, what does that tend to do with the
it's a double-edged sword, because obviously the more money you spend to get the economy going, you need to borrow that money as a government. So you have the negative effect of having to issue more bonds, which is by nature more of them, therefore the yields should go up. But actually,
and if you don't have quantitative easing in place to buy those bonds, the yields go up?
Well, I think QE is undoubtedly still very much one of the policy responses of central banks, and I think they will actually, if they see things moving too fast in any one direction, they will step in and invoke that. So I think it's more just the fact that we're seeing fiscal stimulus for the first time, even from countries that supposedly had legislation against breaking their budget, zero outlook. That the effect will be positive, I think, in terms of the economy. If given that we think this is a one-off shock, given that you've got a backlog of demand in certain things, and that you obviously have supply chains and warehouses that will be relatively empty as well. There's to me, I think there is potentially a good demand pent up to get things going, in which case, I think the curve steepening may continue. This may actually have.
So steepening means essentially the front end of the curve, 1-2 year bonds, 3-month bonds, remain quite low.
That's
because
right.
They're reacting to the current.
They're dragged down by central bank policy cuts, and the long end, the 10-year, 20-year, 30-year bonds, because the outlook is more positive. Those yields,
and the outlook becomes more positive as a function of the fact of all the stimulus that they're doing and the fiscal stimulus that they're doing. So we've got a couple of questions. If there are any questions, fire through. I'm conscious of time because we've done half an hour. So, but just very quickly, guys, and this is a really silly question in some ways, but the crystal ball stuff. Maybe for each one of you guys. I mean, one, have we reached peak news flow? And two, after a 12% fall in equities, do we start adding, because all this good stuff might be coming down the line? Why don't we start with Camille? I think for EM.
I think in China, I think we have reached peak news flow. So the narrative is being managed now very carefully by the Chinese, showing a decline in cases. And to be honest, you always have to be skeptical of the data, but I think realistically, with the very draconian measures they've put in place, it's perhaps not surprising that there is some slowdown in the spread of the disease. But the more important thing is China's just learning to live with it. So continued pickup in economic activity. For me, we have had peak news flow in China. We haven't seen that elsewhere yet. So the question really is, and that will come back to haunt China clearly if this spreads in the US and you have a big reduction in US demand, that will ultimately come back and affect China, less on the supply side, but now on the demand side. So that is the risk. It's this kind of second shoe that is yet to fall, and I suspect we probably have more news flow. But equities are forward-looking. The Chinese market bottomed long before we saw a turnaround in the numbers, and I would imagine that's going to be the case elsewhere as well. But I wouldn't want to predict whether that's already happened or will happen in the next week or month. It will happen eventually.
Yep. Team Macro, what are your views on the news flow? I mean, clearly that's a big driver of interest rates. So
yeah, I mean, obviously the negative news flow is mostly focused on Italy at the moment, northern Italy. It's yet to come to the UK. I don't think we can avoid it, so I expect the news flow to pick up and be more negative in a way. I think we'll do exactly the same as China's done. I think we will come around to learn to live with it. I don't think it'll be an issue in that sense. But when we get to that point, or even actually starting now, we're already looking at rotating the portfolio and trying to pick out good quality risk to put into the portfolio that's going to generate upside for us.
And just on the news flow subject, the US in terms of news flow, I mean, obviously it's a huge country. It's huge from a GDP perspective, and yet there's been very little news flow out of there. There's been a little bit of people wondering how they got it. So, they're not travelers. Is it spreading domestically?
They seem to be at least 1 week, maybe 2 weeks or 4 weeks, behind Europe.
Yeah.
I would say something along those lines. Again, because the world is so connected, I don't think they can avoid it.
Yeah.
They've got a supplementary budget going to the House or Congress this week, I think, maybe Wednesday or Thursday. Maybe it's been brought forward now, actually. News flow's changing quite quickly. And interestingly, the Fed came out with an unscheduled announcement on Friday, late on Friday, after European markets already closed, to say that they were taking the whole situation quite seriously. So things in terms of kind of institutions within the American world are changing and are adapting quite quickly. So I think their response will be much quicker and a quicker turnaround than maybe you've seen elsewhere in the world.
Because they will have also learned, I guess.
Yeah, exactly.
Yeah. So, question for you: news flow. It sounds like we haven't reached peak news flow. What about adding to risk assets?
Well, I mean, I think the first thing is defensive first. I think it's important to be diversified, liquid. We've been raising some cash in the portfolios, and liquidity. I think is going to be very important if this thing continues. So we've always thought liquidity is important. I think this will be a test of market liquidity in terms of illiquid assets getting found out in this next phase. But looking forward, through to the other side of this, we are. It's a bit early to say we're excited, but certainly, markets falling means better future returns on average. And so the opportunity to add some risk in first of all in equities, which will bounce first, and then other areas such as REITs, such as high yield, which I mentioned, we think could be very interesting. And then gold, we still think we've got gold in the portfolio. We still think gold's got an important role to play, given the extreme monetary and fiscal stimulus that we've been talking about today. We think that's a very powerful driver for gold.
Okay, so thank you very much. So just before we wrap up, we've got a question here, which I think is, which is probably, I mean, is there a danger that this is ultimately the kind of mortality of the virus is probably lower than the market suggests, because the cases are probably higher than people are reporting, and could we end up manifesting this problem ourselves? You've got lots of political issues. We've got an election year. Boris is just in. We've got China with trade wars. That everyone overreacts on the hype, and ultimately we cause, our own problems by having knee-jerk reactions, kind of play to the crowd type reactions. Do you think that is
I do think the response of governments to this will be very critical in terms of the economic impact. If they contain as much as China's done, then we're going to get a more severe shock. Whereas if they accept. They try to slow the spread, which is sensible in terms of containing and meaning there's less impact on healthcare, less strain on healthcare systems. But if they do too much, then we know that we're going to get more fear. People don't travel, people don't go to work. Then that could be more impactful on the economic environment, exactly as the question suggests.
Okay, look, I just in the in the interest of time, and I know we have people dialing in from all over the world. Well, I think we will wrap this up. There will be an email recording. I think for us, certainly, it sounds like this news flow in some parts of the world, like emerging markets, is beginning to top out. There's still plenty of news flow to come. There's plenty of volatility to come. Probably we need to watch governments' reactions on the impact that they can have with the economy, and also central banks' reactions around fiscal stimulus and monetary stimulus, because ultimately that could lead to another leg up of risk assets, and in terms of interest rates, steepening of yield curves. So if there are any questions, always get by means get in touch with your contacts at Pacific. We will have a recording of this call that will be on the website before long, and thank you very much all for taking the time, and thanks for the continued interest.